Today, I would like to delve into a fascinating aspect of the financial world: how investment banks like Goldman Sachs sell bonds. Bonds, as you may know, are a vital component of the global financial system, serving as a means for governments, corporations, and various entities to raise capital. Goldman Sachs, a prominent player in the investment banking sphere, is deeply involved in the sale of bonds. It plays a significant role in not only facilitating the issuance of bonds but also ensuring their successful placement in the hands of investors. To comprehend this intricate process, let's break down the mechanisms involved. Understanding bond markets and investment banks. Bond markets are the bedrock of global finance. They provide a channel for entities, both public and private, to secure the capital they require by issuing bonds. These bonds are essentially debt securities that investors purchase, thereby lending money to the issuer in return for periodic interest payments and the eventual return of the principal at maturity. Investment banks such as Goldman Sachs play a pivotal role as intermediaries in these markets. They function as financial middlemen, facilitating the issuance and trading of bonds. Their primary functions in this context encompass: 1. Underwriting. Investment banks assist issuers in defining the terms of a bond issue, including elements like the interest rate, maturity date, and overall structure. Subsequently, they commit to purchasing the entire issue and then selling it to investors, a process known as underwriting. 2. Distribution. Leveraging their vast networks, investment banks ensure the widespread distribution of bonds to a diverse investor base. This entails marketing the bonds, identifying the suitable investor demographic, and structuring the offering to align with market demand. 3. Pricing. Investment banks play a pivotal role in determining the initial price of the bonds, which profoundly impacts the yield and attractiveness to potential investors. Pricing decisions hinge on various factors, including market conditions, credit quality, and investor demand. 4. Documentation. These banks are responsible for the preparation of the necessary legal documents, the bond indenture and prospectus, to be precise. This ensures compliance with all regulatory prerequisites and safeguards the interests of both issuers and bondholders. 5. Secondary market trading. After the bonds are issued, investment banks often take the lead in facilitating their trading in the secondary market. This enhances liquidity and ensures that investors can buy or sell bonds as per their requirements. The bond issuance process. The journey of selling bonds typically involves several critical stages. 1. Issuer's decision. The initial step requires the issuer to make a conscious choice to raise capital through bond issuance. This decision may be influenced by various factors, including the need for funding capital projects, refinancing existing debt, or meeting other financial obligations. 2. Selection of investment bank. The issuer selects an investment bank, often referred to as the lead underwriter, to spearhead the bond issuance. This bank plays a central role in determining the bond's terms and overall management of the offering. 3. Bond structuring. The issuer, working in tandem with the investment bank, shapes the fundamental characteristics of the bonds, such as the principal amount, interest rate, maturity date, and any specialized features like call provisions or convertible attributes. 4. Due diligence. In preparation for the issuance, the investment bank conducts meticulous due diligence. This process entails a comprehensive evaluation of the issuer's creditworthiness, in full compliance with regulatory requisites. It encompasses a review of financial statements, legal documentation, and other pertinent information. 5. Rating agencies. For corporate or private issuers, credit rating agencies step in to assess the creditworthiness of the bonds and assign a credit rating. A higher credit rating typically translates to lower borrowing costs. 6. Legal documentation. Legal documents, including the bond indenture and prospectus, are meticulously prepared to outline the rights and obligations of both the issuer and bondholders. These documents are crucial to the issuance process. 7. Pricing and marketing. The investment bank, in consultation with the issuer, ascertains the bond's pricing, which involves setting the initial yield and offering price. Simultaneously, marketing efforts are initiated to attract potential investors. 8. Book building. During the marketing phase, the investment bank collects orders from investors interested in acquiring the bonds. This process, known as book building, provides crucial insights into demand and helps fine-tune the final offering terms. 9. Final pricing. Based on the investor demand gathered during book building, the investment bank and the issuer jointly finalized the pricing and structure of the bond issue. 10. Execution. Once the bonds are ready for issuance, they are offered to the public or institutional investors. Here, the investment bank can either purchase the entire bond issue and subsequently sell it to investors or act as an agent, facilitating the transaction between the issuer and investors. 11. Listing and trading. After issuance, the bonds may be listed on a stock exchange or traded in the over-the-counter (OTC) market. Investment banks often provide trading services, thus enhancing the liquidity of the bonds. Types of bonds. Bonds come in a multitude of forms, each endowed with its unique characteristics. The specific type of bond chosen for issuance often depends on the issuer's requirements and the preferences of potential investors. Some common bond varieties include: 1. Government bonds, issued by national governments to finance budget deficits, infrastructure projects, and other public expenses. These bonds are often considered some of the safest, given the backing of the government. 2. Corporate bonds. Private entities, such as corporations, employ corporate bonds to raise capital for a variety of purposes, including expansion, debt refinancing, and working capital requirements. The creditworthiness of corporate bonds can vary widely. 3. Municipal bonds. State and local governments issue municipal bonds to fund public projects like schools, highways, and utilities. Municipal bonds offer tax advantages to investors. 4. Convertible bonds. These bonds come with the unique feature of being convertible into a predetermined number of the issuer's common stock, all at the bondholder's discretion. 5. High-yield bonds. Junk bonds. High-yield bonds offer higher yields but carry higher risk due to their lower credit ratings. These bonds are typically issued by less established corporations. 6. Zero-coupon bonds. Unlike conventional bonds, zero-coupon bonds do not pay periodic interest. Instead, they are issued at a discount to their face value, with investors receiving the full face value at maturity. 7. Foreign bonds. Foreign entities often issue these bonds in a different currency, thereby introducing an element of currency risk in addition to credit risk. 8. Asset-backed securities, ABS. These bonds are backed by specific assets, such as mortgages, auto loans, or credit card receivables. 9. Sovereign bonds, issued by foreign governments and often denominated in a currency other than the issuer's domestic currency. 10. Green bonds. As environmental consciousness grows, green bonds have gained popularity. They are issued to fund environmentally friendly projects and initiatives, contributing to sustainable investing efforts.